can either raise your hand, you can drop your message or question in the chat box. You can also use the Q&A section to ask. I'm sorry. Jackie, please over to you. But just, everybody, you get the drift. Please just be civil and let's have a good session, everybody. Thank you. Ajake, over to you.
You just confirm we're all okay. Okay, great. Almost make like the smartest person in the room, basically. You can have really being said or done, but once you're able to share your thoughts and opinions on the recent assignments, then it seems more like you're more involved in the whole process, and you have a bird eye view of the total subjects and matter at hand, basically. Uh, so to confirm, because again, I'd like to make this session as interactive as possible, and I'd just like to keep everybody unmuted, if that's fine.
That's fine, Joker. Good afternoon.
Okay. Good afternoon. All right, thanks. I will pull up the what we'll be talking about today, basically risk, what risk is about, and what not. I'm going to share that with the class. Okay.
Joker, are you having any technical issues?
Hi, Abraham. So I think Joker was having issues with the network, but she's back now. I think she's just trying to connect her audio, but she's been able to join back, I think.
Okay.
Yeah, she's been able to join back. So Joker, you're muted in case you are speaking. I think you're back in the room now. Hi, Unilola. Is it possible? Are you able to unmute Ajoke for some reason? She's unable to unmute herself. I reckon she should be able to because she's a co-host. But is this something you're able to do
Yes,
for me?
she should be able to.
Oh, okay. Ajoke, do you want to sort of log off and try to reconnect again? It can be a technical issue, but perhaps if you're able to sort of log out and reconnect, that might resolve the issue.
It's definitely a network issue if she's not able to unmute, I mean.
Okay, hi. I guess I'm going to use my phone. I'm going forward. For some reason, I can't do that on my laptop, but I'll be using my laptop to share a screen. All right. So I thought we're going to take us through the curriculum for today, what we're about. Basically, I'm investing, fundamentals of investment risk. I'd just like us to get a feel of what we understand by risk and then how it's related to investment. If anyone would like to lead with that, just get a feel of the class, basically. Okay, is it fine if I just do a pick and choose? Ikechukwu, would you like to share your thoughts? Or Ayonfelua, anybody works, basically. Okay. All right. Emmanuel, would you like to share your thoughts on what you think this is about and how it's related to investment? Okay. I'll just give us the run through basically. Risk is really anything that's out of the norm, what's not expected. It's largely uncertainty, to be real. Textbook definition defines it as a probability or uncertainty of losses rather than expected profit from investments due to a fall in the fair price of securities and whatnot. So essentially, we're just trying to understand. I mean, after we've done all our business analysis, industry analysis, selecting a company that looks like a good venture, a good investment or vehicle to put our money in, and we're trying to make recommendations. We also have to think about the probabilities of our forecast expectations and projections are not going as is. That's actually what risk is about. I mean, there's a whole lot that goes into determining the fair value of a share or of a stock, basically the fair value of a bond or any security, essentially, and that's largely backed by underlying assumptions, which is why I'm sure if you've gone through all the other courses in preparation for the CFA research, they're largely backed by assumptions, which is why they have to be as realistic as possible. And then we're just also trying to see not to put all your eggs in one basket. In terms of how to look at risk or investment risk, we're not trying to say be pessimistic at all times. We're not trying to say be optimistic at all times. We're just trying to ensure there is a balance, a reasonable balance that makes a reasonable investment case or a practical investment case after taking everything into cognizance, right? Going forward, we're going to just have a review of all the types of risk. Basically, it's a broad spectrum. It narrows as far back as geopolitical risk to the tiniest bits or operational risk that might impact what your forecast of valuation might be. There is a macro element and there's also the micro elements like typical economics or industry analysis. Basically, we're just going to run through that. Before I go ahead, can I ask people to unmute? So we just make this as interactive as possible. Hi, Ikichuku, welcome back. If you're off, I was just trying to get a feel of what you guys understand as risk and how it pertains to investments, basically.
Joker, I think there's a comment in the chat box.
Okay, 1 second, please. Okay, nice. I mean, basically what I was able to run us through, probability of loss is related to an expected return. Okay, thanks. So in your own, if it's fine, I'd just like to go ahead and with you, Emmanuel. In your own understanding of nature, what when you say probability of loss is expected return, can you break it down like Riemann?
Okay, I'm sorry, can you hear me?
Yes, you're audible. Thanks.
Okay. That's I was sure. So thank you. So in terms of losses, that could be different forms. That could be financial losses. So that means exposure to certain risk factors or different and by degree as well. That's not just impacts, but by also not just by probability, also by impact can affect our financial losses. So maybe changing operational efficiencies caused by macroeconomics, maybe inflation or something could actually affect the profit margins of the company. A good example could also be something like the operational risk. So changes in value perception could also affect the sales of the company, amongst other things. If I answer the question.
Okay, nice. I mean, fair. Really good, thanks. I'd also like to just point out risk doesn't necessarily have to be bad, doesn't have to be red flag all the time. It can actually be risk that supports upside risk that supports your forecast, or risk that supports even better growth and whatnot. And it's also important to understand in terms of investment risk, there's risk you will get it right, and it is also the risk you'll get it right in terms of maybe your forecast markets and hitting your forecast or your projections. There's also the risk where you have say being too pessimistic, and then the market outperforms or goes wild basically, and then basically outperforms your forecast. So there's that risk of not getting it as right as you would have, which actually is a positive thing. I'll just run us through again. So the types of risk that we have are market risk, default risk. I mean, all these things are everyday things we actually consider in our everyday lives, essentially. It's just that we're not as detailed or as focused on it as we would in terms of, as opposed to when we're investing or proposing an investment option to a client. Because I mean, I'm here, we're talking about money, and it's largely almost a really significant sum. So you always have to be sure that you're crossing your eyes and dotting your T's, and you have uncovered every potential impact or risk, or I mean everything that could go wrong. You have basically flogged it properly, and then you have a clear picture of what is happening. Right. So for the types of risk, we have the market risk. Market risk, I mean, I just like start from the top basically. Top that covers everything, geopolitical risk. And I mean, this is the risk that everybody largely always needs to have an understanding of, always needs to have a clear sight on, because it helps even direct from the global perspective, directs what the domestic perspective would look like or should look like. It feeds into a whole bunch of things. So our ability to understand the geopolitical area or the global area basically gives us an insight into how we expect this to trickle down into sub areas and also to the investment at hand. So for geopolitical risk, then, but I'd like to share, the understanding of what's currently happening and how you expect this to trickle down, basically, because it's basically not all story about maybe this year is the election year for mostly half of the world would be going would be voting people into public positions, public roles, basically. It's also how to see how that impacts the trajectory or trajectory for policies, forecasts, and whatnot going forward, and how that impacts and trickles down into the emerging markets, domestic markets, and then also the industry and we're particular about for this research session. Okay, trying to unmute you guys. You guys can drop suggestions or point out about what you think the global risk is or the geopolitical risk can be. Emmanuel, would you like to share anything, or Khadija? I'm unmuting you guys, so can you accept the request on mute?
Um, so in regards to your statement, I guess what came to mind was, as you mentioned before, there's lots of conflicts in the Middle East, which has like an effect in oil prices. So I'm guessing there's a strategy between the governments, maybe it's like Israel or America, that's United States, like the escalation to increasing of prices or an escalation that could lead to further increase in prices.
Okay, fair enough. Thanks for the input, Emmanuel. Again, that's largely all he has said. Just to buttress or piggyback off what Manuel has said, the whole sphere, everything that's happening on the global scene, across developed markets, across developing markets, and then how that impacts your outlook or vision about your domestic market or your industry particularly. The easiest we can pick on is all of that geopolitical tension that's currently happening across developed markets. Basically, we still have the ongoing Russia and then Ukraine deal that they're battling with. We have the whole unrest in the Middle East region, particularly. We also have the growing or brewing tension between US and then also China. Yeah. And then a major impact that everybody has seen, and it has largely trickled down into across sectors, across industries, has been the whole effects of this on commodity prices, basically on raw materials, essentially, and how that has trickled down into profitability of. I mean, it has happened across the market, both developed and developing markets. We're seeing how that is, it's in a way, returns and then profitabilities of all of these companies, in particular the consumer goods industry. So again, we're just saying all of that to be intentional and then focused about what is happening and then how that trickles down into different space, right? We also have quite a number of risks. We have the market's risk. Market's risk largely is the risk of an investment losing value due to various economic events that can affect the entire market. So it's not just tied to one company or one industry and one sector, but across the entire market. And we can pick this from, again, the geopolitical, the global risk or geopolitical risk space, where maybe one unrest or one fight happens and then impacts almost everybody basically, or there is a positiveness or positive reaction. Take, for example, the whole inauguration of the new president in Nigeria, and how that's also feel positive sentiments across securities in the domestic space. And we saw how that impacted share prices across sectors. So if we had done a forecast of expectation of where prices of the Nigerian stock exchange would close at, that would have significantly been different, either positive or negative, because of the unprecedented rally we saw throughout last year. So it's largely the risk that anything that happens in the markets affects everybody across the spectrum and then impact our forecast either positively or negatively. For market risk, someone like to maybe point out an example of a market risk. I just pointed out the new presidential swing that happened last year for Nigeria in particular. Is there anybody that has anything that just gives a brief or a good reflection of what market risk can be about? Okay, I guess before we answer the question, I'd just like to also confirm if we're in line or in tune with the financial market and all the activities that has played out over the years. So I just know how to, pick expectations or pick examples. Danielle, would you like to share a suggestion, or David? Okay. Khadija, would you like to share something? Are you accepting my request to unmute?
Hi, good afternoon.
Hi.
Okay, so an example I can think of this market risk coming down from the geopolitical risk will be going back to the Russia-Ukraine war and how that sort of affected the supply of grains in the global market and sort of also trickled down to the prices of bread and some of those products that rely on these grains in the markets, in these industries in various countries.
Okay, nice, thanks. Ayofela, do you have any other suggestions? I'm requesting to unmute. Pelumi, feel free to share also. I'm requesting to unmute. Okay, while you guys try to figure that out, I just also like to say, just piggybacking off what Khadija suggested about the whole impact of the Russian-Ukraine crisis happening on commodities and then down to the price of the everyday bread, basically. I mean, nobody could have foreseen or forecasted or projected that whole crisis happening. The same way nobody could have forecasted COVID, for example, in 2020, major COVID thing happening, or any other insurgency that's basically happening. That's like quite a bit of a stretch in terms of forecasting. So you'd also like to keep in mind the ability of a typical investment analyst to be as proactive as possible and also fluid as possible in terms of reviewing the analysis and then projections following every major unprecedented news that could reasonably not have been accounted for during the initial forecast or projections. Essentially, I mean, it's fine for forecasts to go out of sync, as much as you'd like that to not happen. But when, I mean, there are uncontrollable factors, of course. I mean, nobody could have projected or forecasted that, right? So it's essential to keep in mind the need to be fluid and then need to be proactive in terms of reviewing your opinions, your recommendations, your forecast and adjustments as quickly as possible. Another one that comes to mind in terms of the market risk, basically impacting sectors of share prices across some spectrums, would be the recent fallout of banks in the US, not the major banks, of course, but the small to medium banks. I mean, it was good the Fed came in quickly to swoop in and then also save the moment. But that whole the whole perception lingered on, and then we could see that impact across emerging hard currency securities, mostly Euro bonds, and then also, in fact, even equities in the US. But then the reason we didn't see that impact as much in the domestic space was because of the level of participation of foreign and domestic investors in that space. So in as much as we'd expect to see market risk impacts, typically impacts across sectors or across industries or even across markets, there are times where there is that exception. And that is what we saw in the Nigerian space, particularly in the equities markets last year. So like I said, the major types of market risk includes equity risk. Again, the risk pertains to the investment of shares, that the market price of the shares is volatile and keeps on increasing or decreasing based on various factors. Case in point, the market rally we witnessed in the Nigerian equities markets last year, following the inauguration of the new president, Bola Ahmed Tinubu. Volatility also, just important to note, the volatility most times from a fund manager, portfolio manager's point of view, is actually needed if we're intentional about generating as much return or as much alpha as much as possible. I mean, for quiet markets, it's more difficult to generate returns in a quiet market than you would in a more volatile market, because you have that opportunity of entry and exit positions in assets every now and then, essentially. So equity risk largely pertains to any risk that can impact the share price of a particular security. And this is largely underpinned by volatility, which could be due to a number of factors that we have listed from the top down, doing the top down approach of risk, basically. We also have the interest rate risk, which applies largely to debt securities. We have, or we're aware about the inverse relationship between debts, the interest rates, the yield on the debt security, and then the market interest rate. We have that inverse relationship. So where markets expect or project an increase in interest rates, and that doesn't materialize, we see that volatility manifest or occur in debt securities as price acts accordingly, essentially. So again, that's why it's important for most fund managers that have that in the fixed income or debt space to always be really frugal and really prudent as to their projections and forecasts and expectations, and they do that to round trip about uncovering them stones, and then even trying in the extreme to consider any other factor that might arise, any other factor people might not think of. And basically, you see portfolio fund managers doing that a lot in the debt space, largely pertaining them to interest rate risk. We also have the currency risk for market risk, and it also pertains to foreign exchange investments. Like this is the risk of losing money on foreign exchange. Take, for example, a typical foreign portfolio investor that comes to that does that currency exchange and invest in the equities markets. As much as he's particular about the returns he's able to generate in the equities markets and domestic currencies, also focus on the exchange rates and movements and then volatility in that space, because it's important when he wants to repatriate his funds or translate all his gains that he's able to generate them in his domestic currency, which would be in the foreign currency. So the risk, again, that anything happens to FX or exchange rates in Nigeria, and then that whole gain is basically wiped out. And we saw that impact in, that movement when FPIs largely exited the equities space in 2019, between 2019 to 2018, largely as we're super concerned about the likelihood or the increasing expectation that the federal government or the CBN largely was going to devalue Naira, devalue the currency, which was weakening their return on their portfolio. We also have currency risk in the space of, for hard currency securities, like you say, the Eurobond space, where, for example, Ghana, they've been trying to get FPIs into their local bond space, and we've seen interest rates increase in that space. But then, in addition to making domestic currency or the domestic security instruments profitable or attractive for foreign portfolio investors, it's a major currency risk, which is almost a major concern of foreign portfolio investors largely, would see that impacts their decisions as whether or not to invest in domestic equities or domestic government securities or whatnot, basically. So those are the three sub areas that we will typically look at when we're looking at the market risk that can impact securities or share prices across industries largely. So next I'll move to liquidity risk. This is more realistic, something you can evaluate and then detect, because in addition to understanding this risk and pointing them out, it's also great to be able to quantify them and then also measure them essentially. So liquidity risk, would anybody like to take a shot at liquidity risk, what that's about? It's almost self-explanatory, but I'd like to hear your opinions. Odiat, I'm requesting to unmute. Would you like to share your thoughts? Or Timilade? Okay, I'm happy to hear your thoughts also. What do you think liquidity risk is about?
Hello, Joke. Did you say liquidity risk?
Yes.
Okay. From what I understand, liquidity risk is simply the risk that a company faces when it may not have the ability to settle its short-term and long-term obligations when they fall due. So when it doesn't have those resources, especially cash, to settle those short and long-term obligations.
Okay, great, thanks. Thanks for the time. That was great. From your point of view or your perspective, basically, I'd say that's pertaining to a particular company, essentially. That's right. But for the purpose of this, which is actually a valid point for looking at it from another perspective, but I was more concerned about looking at a market, a securities market, equities, debts, whatnot, what that risk is about in terms of liquidity.
Good afternoon, ma.
Hi,
I
good
don't know.
afternoon.
Okay. From my point of view, when you're looking at a market and we're talking about liquidity, I think liquidity risk is the level of certainty or uncertainty to generate cash, basically, or to exchange a particular security for cash.
Okay, all right, great, thanks. I mean, thanks for these two point of views, quite solid, largely. So following up on Rodia's point of view, largely liquidity, we were talking about looking at it from the market perspective before we go deeper into individual companies. Like we heard Pelumi share earlier. So as Rodia said, Rodia, yeah, it's the risk of being able to largely convert whatever securities you're holding into cash, right? And then the risk we'll be assessing is the likelihood that doesn't materialize or come to fruition. Basically, essentially, you're unable to sell securities either at the current selling price or largely unable to even convert it into cash at all. And in that space, when we're recommending a company for investments, it's a key or significant risk we'll always have to consider. And considering that, we'll always look at what the outstanding issue of shares is, and then what that shareholding structure or composition is about. For Nigeria, we know, or for the Nigerian equities exchange market or equities markets, we know the minimum amount that is regulatory required for companies to float in the equities markets, provide liquidity is about 20%. So if we have company A that has a float of 10% and we have company B that has a float of 40%, in assessing which would be a better investment option, would of course consider the possibility of one even getting, because float has a lot to do or plays a major role in even being able to acquire those shares for investment and executing your investment strategy or exiting your investment strategy and then disposing of those shares. So if we're assessing two companies and then one has a greater float and then one has a lower float, a premium in terms of opinion and consideration would be attached or given to the company with the greater float or greater liquidity, as opposed to a company with the lesser float or lesser liquidity. And again, this would also feed into what the investment strategy actually currently is. So if we have a tactical investment strategy, say a short-term play, and we have two companies we need to assess, in as much as a company that's less liquid may prove to be a more profitable option because of the time frame or the time horizon that we have. We would, of course, again, attach most likely give more allocation to the company with the floats that's a whole lot more, because you're trying to also target what your entry and exit period will be, and also try to have a fair picture of what the market liquidity would be in that state. If you're able to exit at a particular time period to realize whatever profit or return you've been able to make. Largely due to less liquidity in the market, the investor might have to sell securities at a much lower price, thus losing value. And there's so much liquidity in the market, so much demand for this, there's also a chance of selling at a higher price, again, due to the demand, or due to, demand, and then how intense or important and that demand needs to be met largely. An easy way to do, again, not sure. I'd like to think we're all, I mean, I don't know if we have access to the Nigerian equities market. We have most investment firms or investment houses with their software slash application, basically, that grants us some access to the market. So if we're to look at maybe Ameritrade, for example, or I think Greenwich also has one. If you can look at that, I can share links with you. But I mean, it's typical fintech guys that are also promoting financial inclusion and then investing. So the Bamboo, Chaka, I think, and whatnot. I'll just find a couple of these and then share with you guys. We're able to see what the asking price and then the selling price is for both demand and supply of this time. It also helps us gauge or view what the liquidity of the market is at that time. We have something called the bid-ask spread, which again largely helps us to have a fair picture of what liquidity is in at that time. So take, for example, a security A that has security A that has a bid price of 8 and then an ask price of maybe 8.5, and then security B that has a bid price of 6 and an ask price of maybe like 4.5. The difference between the bid and an ask price is largely the bid ask spread. And the higher the bid ask spread, the more illiquid investors would perceive that instrument to be, either illiquid or the what's it called? The people who would like to buy it, the buying interest, yes, is not as solid to command them a higher price, because again, investors are also looking at what the possibility of them exiting that security if they get into it. So the demand interest is not really as strong, and then the supply interest might not really be as strong because there isn't so many people even willing to sell, or people aren't willing to sell at the demand price. I mean, essentially, what I'm trying to just say is to assess liquidity and whether or not this fits your investment profile or investment strategy in terms of return generation, investment horizon and whatnot. It's important to look at the market as a whole, see what the bid-ask spread is, and then also look at each individual stock or security as a whole, and then see what the bid-ask spread is, to get a fair idea of whether or not this is actually as liquid as you would expect or you would think, or not as liquid as you expect or you would think. Okay. So far I just want to confirm we're following, and then I mean I can move on. But if you have questions or suggestions or comments about these two risks that we have touched, I'm happy to take them or answer them. Or different opinions, basically, I'm happy to address that too. Okay. Okay. We'll just move on. Our next risk I'd like us to talk about would be the operational risk. So we're largely done with the market risk. What could happen on the global space, looking at a market in general, larger market and liquidity risk, and concentration risk, basically. We can also have a good view about this risk on a company by company level. On a company level, basically, particularly liquidity risk that Pelumi shared about. Pelumi's point of view would relate or pertain more to a company level assessment of risk, liquidity risk, which, like he shared, is the risk that the company is unable to meet its obligations, or it's not as liquid to meet its obligations as when due. And then we also have financial risk and a bunch of other issues to assess what the liquidity risk of a company can be or is expected to be when compared to the industry or peer average or peer comparison in general. So we're going to come down to the credit risk. Our credit risk for the equities markets on the market view before we go down into a company by company view, basically. For credit risk, this is again the risk, largely the risk of default, the risk that a settlement may or may not occur. This would more, because of the way the Nigerian equities market is structured, where we have it's an exchange system. We have a clearing house, we have a settlement house and whatnot. It's highly, I wouldn't say it's impossible, it's highly unlikely a credit risk would crystallize in the equities market, unlike any other securities, maybe a private placement or a private market or even a debt market, because of how that market is structured, basically. So for a bond market or a debt market, it's most likely an over-the-counter market, which again is riddled with credit risk. So the risk that the counterparty defaults, maybe the counterparty does not have enough money to meet settlement dates or extend settlement dates, and you have to have that back and forth largely over the phone. But with an exchange system, that is minimize them to the barest minimum, essentially, because we have a clearing house, a settling house that ensures that monies are received before securities are exchanged, essentially. So on the market level for the equities market, we may not see as much credit risk crystallize. But on a company level, again, because like I said, it's the risk of default. So it's the risk that the issuer of a security on a company level, either debt or equity, most likely debt for a company, or even equity, may face like financial difficulties and then would be unable to meet that obligation as when due. For companies, it could speak to any type of debt security, be it short-term or long-term, long-dated or long-tenured securities. And it could also be either on the part of the company itself or the part of the company's counterparty. Either they're expecting like a receivable or they're expecting a credit line, and then that just disappears into thin air basically, and that doesn't materialize, and that crystallizes and becomes a credit risk. Or the company is meant to meet a certain debt or equity obligation, and then for some reason they're unable to do that. That's basically what credit risk is about. And a major way to, it's great because for credit risk, we're able to measure and then quantify the level and then degree of risk or impact that would have both on the company, its reputation, its business operations, and then also its health status in terms of ratios. So we have quite a number of liquidity and then credit risk ratios that would help assess this risk. Would anybody like to share, Olabisi, say an example of a way to measure credit risk using financial ratios? I'm requesting to unmute, so you can grant that out. Great. Daniel, if you could unmute also, just to share your thoughts or opinion, that would be great. Again, send this request to unmute. To Daniel Lawal, if you'd like to share your thoughts, that would be great. Hi.
Hello, sorry. Good afternoon. Sorry, can you come again on the question?
Okay, I'm saying for this risk, it's also important to be able to measure and then evaluate the degree or the impact they can have on companies. I mean, for credit and liquidity, we have a range of financial ratios to help with that. If you just point one out and then share your thoughts on that, why you think that helps to assess risk on a broad field, that would be great. Remember how we discussed credit risk is the risk of default, and liquidity is the risk of not being able to meet your obligations as I went with that long term or short term. Yeah. You're unmuted again if you're speaking, Tim Ladi.
Yeah, so I think for liquidity ratio, for liquidity risk, we can use the liquidity ratio basically to measure the ability of a company to meet up the short-term obligations. So, and I'll be making reference to the current ratio. So in order to assess the available current assets that the company has is with respect to their current liabilities. So
Okay, nice. Thanks, Ladi. I mean that was a great one. Currency ratio basically to help to assess whether or not they can meet their obligations, their short-term obligations as at when due, basically. So I mean, I think just at the end of all this, just important to know that when we talk about risk, we're able to measure and then quantify that, and also assess on what the impact is, evaluate that across peers and also across industry, because it helps put, for lack of a better word, like a face to the whole explanation. Basically, we're not just all talking, but then we can actually put them into numbers and then see whether or not they're as the degrees are significant or not significant as possible. And we can make investment decisions based on that risk. Also talking about in-house risk or internal risk when it comes to company cases, we have the operational risk. So operational risk largely is, I mean, we say business, if it's operational risk largely is the risk of everything that might go wrong operationally when a business is trying to render or deliver services, its preferred services to its clients actually. And this again can span across departments or across units in a business. So it can either be maybe as little as the gen or power not coming on at the required time, and thereby losing X number of hours that could have been channeled into productive use. Or it could be as large as maybe an employee essentially largely for say an investment research house making recommendations publicly without the disclaimer that the opinions being shared are just his opinions and not opinions of his employer, because that's largely may or may not cause some reputational damage for research houses basically, as most employees are a representation, or by an extension a representation of their firm. And that's why it's really important to always have that disclaimer about your opinions being shared being yours and not opinions, shared opinions of your employer. So it can really go across whatever spectrum we like to think about. It can also be on the operational bit, say a payment transaction failing, or some amount not being refunded for fund transfers basically, and then it makes the business as a whole miss deadlines and be liable for penalties, and might also even throw them into legal issues or whatnot. And we had a typical case of at my previous firm of payments not going through. We were trying to execute an investment strategy, and then we sent funds, but for some reason the funds got stuck, either due to a general NIBS issue, NIBSS issue, or an error on the operational units of our own parts. And essentially what that happened was we lost interest for quite a number of days, and then the money was not in the account and also was not in the final party or receiving party's account. And so that led to a whole lot of back and forth, a whole lot of reconciliation. We basically just had to allocate time that could have been used to talk about more investment strategies or more about investment execution into reconciliation, which again impacted, I mean, the final end was impacted what our revenue targets should have been for the year, right? So these little things can actually build up and then also balloon to cause significant impact or changes in a company's trajectory or a company's strategy for the year. I mean, so whatever it is you can think about for operational risk, again, it's in terms of financial issues and the financial tools to use to assess operational risk. They would, I mean, they're not as readily available. So what companies typically do is to have internal policies and internal controls in place to measure effectiveness of productivity and then have a target to ensure that, I mean, minimum standard of practice are being met and whatnot, essentially. So in evaluating a company investment or a stock or investment option, basically would want to, and then we're trying to assess the operational risk. A good pointer could be either the cost income ratio or the profit operating margin. Basically, what the cost income ratio has been for a typical bank would help to see whether or not they have been really prudent or effective in bringing down or managing costs to a considerable level to help and boost on what net and marginal net profit should be. For a consumer goods would be typically around the supply chain, what the either inventory turnover is or what the inventory turnover is, basically what the asset turnover is. So if they're able to be as efficient as possible to ensure that those numbers are either internal targets are being met or those numbers are better in terms when compared to their peers or to the industry average. And we'll just have a sense of what the operational efficiency might be and whether or not the operational risk of that company is high or is low or is at a considerable level. So I mean, they're just like a whole bunch of risks to look at, the different ways to look at it, different ways to quantify it, to measure it. And there are also different insights in the financial statements that can give you different indicators that can give you insights into what these risks are, how managed or how and whatnot. Dr. Adedimo, did you want to drop a suggestion or a comment?
Hello.
Hi, Dr. Adedimo.
I'm just following. Hello.
Hi.
Yeah. Are you hearing? I'm just, yes, I just joined, please. Just came back from church shortly. Just joined. So I'm with you, please.
Oh, okay. All right. Thanks. Welcome back.
Please go on. Carry on. Yeah. Thank you.
Okay. I mean, after going through on all of this risks, we're going to go back. I mean, we've discussed the case of just credit risk, but in terms of market risk, how to quantify that or measure that. Thanks. If you could mute now, that would be great. Thank you. So in terms of measuring the market risk, I remember we mentioned market risk would be the equity risk, the interest rate risk, or the currency risk. There is how to identify the key market and risk indicators. For market risk, for equity risk, we mentioned that is the risk that there is the risk of volatility, basically, that presents itself or manifests in the equities market. Like I also mentioned, as opposed to a quiet market where there is really not as much activity or as much movement driving changes in prices, fund managers or portfolio managers I'm more in favor of volatility in the market because again, it helps us it provides multiple entry and exit opportunities where we're able to generate returns, right? But how do we measure or quantify that whole volatility? That's where beta comes into place. And before we start off with beta, I'd like to confirm if we have like any idea of what beta is from the previous sessions or courses we have taken, maybe valuation courses, or I think valuation course that should come up in valuation courses. You guys have had valuation session or we haven't? Okay, so I just take that as we haven't, and it just run us through what beta is. And I'll also be sharing an Excel file to help us calculate in real time the beta of a stock and then see how that trickles down into, again, our perception of how well the stock moves in line with the market, or how well it moves or how well it doesn't move. Because aside from the equities markets where I mentioned about the risk of stocks going up, share prices going up or down in line with what the market is currently saying, there are quite some really defensive stocks basically that do not move, or they're not as volatile as the market. So they're not as sensitive to changes in market prices or market news as you would expect. A particular one would be the company we're going to be doing this research or building this investment research on would be CAP. If we were to look at the share price of CAP is not as volatile a stock as you'd expect it to be, regardless of whether or not the market is up or down. So most portfolio managers, back in Mary STEM, during that whole market volatility, my top go-to stock to preserve capital and wait out any market volatility would be to buy into a CAP stock. Or CAP was just always my go-to, largely because it was super stable and then also helps them to preserve funds, basically. So again, let me just share that with you and then confirm you guys have the Excel so we can run that through. Moment, please. I should be able to. Okay. Okay, I have just shared that. Yeah, I've just shared that in the group chat. If you can have that open while I run through the explanation of, but I just basically do a run through of what beta is about. As like I said, beta is largely a measurement of volatility of returns relative to the entire market. So what we're trying to do is we understand the market moves, largely due to news or any other happenings that might occur at a particular point in time, and then the market responds to that news or has a reaction to that news. And we also know that there are also some stocks that independent have that may or may not react as much as you expect it to do in line with what the market is saying. So you'd have for example, maybe any stock in the banking index, in banking ticker, they're known to be more volatile, as they have a more, again, largely driven by liquidity. So whenever there is a market news or a market reaction, you largely see more of that reflect in the banking stocks. Also within the banking stocks, there are also a couple of tickers or stocks largely that wouldn't move or have as much volatility where there is a market news or a market reaction, basically. So we have where we'll see maybe a Zenith Bank do like a 2 or 3%, 2 or 3% either up or down in terms of movement, where there is a market news, and then we have that reaction across across comps or across tickers. We would have maybe a Jais Bank or a Unity Bank not move as much, again, largely driven by liquidity. These stocks are not as liquid, even though the banking ticker or bank sector is regarded as the most liquid sector on the exchange. But we'll see maybe a Jais Bank or a Union Bank or Unity Bank not move as much. So again, we're just trying to understand or measure or capture that movement in line with the markets, which again is important if we're going to be as precise or as reasonable as possible in terms of recommending or arriving at a target price or a fair share price for a company, right? It's used as a measure of risk, and then it's part of also the capital asset price model, which is why I try to confirm if you've had that valuation session with the facilitator before, because again, beta is one elements that would be discussed or elaborated in more detail, actually. So we're trying to, for beta, we can have what we're trying to do in measuring that whole movement in line with the market movement to see how sensitive or how volatile the correlation largely is. So we have the beta of it could either be 1, 0, or -1, or less than 1, basically. When we have a beta that is equal to 1, we say the stock is just as volatile as the market. So where the market does largely mirrors the market movement, where the market does a 2% gain, we can see the stock do either plus or -1 percentage point in that regard in terms of return generation. We have also betas that are less than 0. So we say they're negatively correlated to the market. Basically, they have like an inverse relationship to the market. So where the market either goes up, we might see that stock generate some returns in the opposite direction. So it might go down, or it might not go just as much as the market would basically do, right? When we have a beta that's less than 1 or equal to 0, first or equal to 0, say the market, these securities uncorrelated to the markets. Again, for the purpose of this is important in terms of measuring or quantifying what the beta is and how the markets or how the security moves in line with the markets, because it helps also in determining what the allocation or composition of stocks or investment recommendations to give if you're trying to curate an investment portfolio. As much as possible, would like to, even within the equities market or even within a particular sector or a particular ticker, I would like to have as much diversification as possible. So I also like to include or have a composition of stocks or companies that do not have the same relationship with the market in terms of volatility or movements, basically. So we're trying to have that diversified portfolio as much as possible. And again, that's why the beta is important. So if you guys would just confirm you have that Excel file that I just shared, and we have that open, then you can just do a quick math or a quick run through of how that is computed or how that is arrived at. David, Francis, I'm asking to unmute just to confirm you guys have that. So you can drop that on the group chat. And I can just confirm everybody has access to this Excel.
Oh, please, she already sent the Excel to the meeting chat, so you can just easily download it. Please download and confirm that you have it open.
Okay, thanks, Team Nadia. I see you have that and you have that open. Thanks, David. Once I have like a couple of confirmations, I think we'll be good to go. I have from Team Nadia and David.
Also raise your hand if you don't want to chat. You can raise your hand to confirm that you have it.
Okay, thanks, Khadija, for the confirmation. All right, thanks, Dr. Adidera. We have it open. So I'll just wait for the other guys to confirm, and then we can do a run through of all the steps on how to calculate beta in Excel. Again, from my explanation of what beta is and how that relates to your projections or your forecast in terms of share prices and investment recommendations. And we mentioned a lot about movements in tandem with the market, what the market is doing. For beta, what we're trying to do, like I said, is just see the degree of relationship, if I can call it that, of a security price or a security of a stock to the market. And what helps us do that is correlation, basically. So what we're going to do is do a little bit of math. If we have that open, I already have that open. We have the first and then the second page, right? Or the first and second sheets. The first sheet largely is a works example. So we'll be using the second sheet to compute that by ourselves. So we have a clear picture of what we're doing.
Hello, Joke. Hello, Joke. Can you hear me?
Yes.
Okay, do you mind sharing your screen?
Okay, great. Let me share it. Because I can. 1 second, please. Okay, great. My screen is up. All right. So as we can see, we have the share price of Seplat, and we also have data, rather. We have data of Seplat share prices from 2018 for 1 year to December 2019. That's basically 1 year. We also have data on the exchange, where the exchange, the index stopped at basically for 1 year. The idea is to have as much data as possible. 1 year is sufficient, but if we can have, nobody's stopping us from having 2, 3, or 4 years, just to have a clearer picture, a long-term view or picture of what the relationship really is, right? So we have this for the NSCSI, when was that 31,000 points, 31 to 41,000 points. But now I know we have that currently at about 60 or above 60,000 points. I'm not quite sure what the number is at yesterday. But yeah, where do we get that information from? We can easily get that information from Bloomberg or from any other websites that shares historical information about share prices of Nigerian stocks. again, we can just do quick research on that and then share a couple of things with you about where you can get that for free. Or if you have relationships and within your network that have constant or regular access to Bloomberg, you can just reach out to them to help download that share price and history of any stock you're interested about to do this computation. So what we're going to do, again, if we go to the beta 2, the second sheet, okay, great. We're going to find what the daily change in these share prices. That's what the daily return is for both the stock and then also the markets, right? And that's going to be just the return for the next day divided by the return for the previous day minus 1%. Do we have that? Can you confirm you're with me on this? I'm happy to have that on the group chat or anything.
Please, if you're not clear on what she just did, please indicate. You've stopped sharing your screen. Did you stop sharing your screen?
No, it's still in.
No, I can't see your screen anymore. But please, if you don't understand what she did, please indicate so that she can go over it again. If you understand, just also indicate. Okay, someone is with you. Somebody working, but they understand what you're doing.
Okay.
But please,
great.
if you don't understand, just indicate so that she can go over it again. Okay.
Okay, great. Okay, so all right. All right, thanks, Khalid and David, for your inputs. Thanks, Emma. I can see you with me. So like I just run that through again. Again, we're trying to understand what the relationship is, right? The degree of correlation relationship between a security price and also the Nigerian exchange in this case, right? Or any exchange and platform we're concerned about, right? And what I did was to get us the price history of Seplat, for example, over 1 year. That's from 2nd January 2018 to 2nd January 2019. 1 year is sufficient for this class, but it's advisable to go as far back as possible. So you can get it at 2, 3, 4 years, just to have a long-term view, a broader view of how the change really is, or the movement in prices really is, to get a better idea of what the correlation or degree of movement this share price or this share has in relation to the markets, which would be the NSCSI or the Nigerian Exchange NGX, that's what it's currently called at the moment, NGX, right? So what I did again is to get what daily return is for Seplat. That's what we'll be doing. That's daily change in price of both Seplat, which is the stock we're currently considering, and also the NGX, Nigerian Exchange, which is the equities market that we're considering currently, right? And I also said we could do a brief. I was doing that, so I'll do that after this run through of a couple of sites that share or that offer this service of sharing price history of securities you're particular about, and also the Nigerian exchange for free. You can go as far back as 2, 3, 4 years, right? And also, if you can check within your network of people who have constant regular access to the Bloomberg, to the Bloomberg platform, you can also reach out to them to help spool this data. I'm also happy to share that with you guys. For the company will be reviewing HSF, which is CAP, sorry, or I mean any other company you're particularly interested about, right? So either the Bloomberg or you just do a bit of research about some sites that offer this service, right? So what we did again was check for what the daily change in price is, what daily change in price movement is, which is the previous price, the new price divided by the old price, largely which is what we did, C3 divided by C2. And that's what we've done. So I just need to confirm everybody's with me on this. Khadija and David, are you guys clear now? You can drop that on group chat and I'll just pick that up. Okay, great. Thanks, Khadija. So what I want to do is replicate this that I have done for the NGX, which is also basically the new minus the old, right? Thanks. All right, thanks, David, which basically the new minus the old. And then I want to replicate that for all the years, or for all the days rather, which would be, can just do a simple drag down, or a control copy and control paste for these data that we have. Once you guys are done with control copy and paste, just let me know. So we have this new information, or this new data. All right. So what this data does is just tell us what the daily change, what the daily change in CEPAT and then also the NGX is. For better interpretation, we can use that as the percentage change also. So basically it's saying from 3rd of January 2018, 2nd of January 2018 to 3rd of January 2018, CEPAT returned 0%, right? For the day. And then from 3rd of January to 4th of January, returned 3.80%. Now, if we review that with the markets too, we're saying here, the same day CEPA returned 0%, the markets returned 0.27%, right? And at the same time period, CEPA returned 3.80%, market returned 0.66%. The same time period, CEPA returned 0%, market returned 0.06%. So we're able to see how the market moves in terms of generating return and also how CEPA moves in terms of generating return, right? For all of this is data. So if we want to establish what the relationship is between these two returns, right, we'll use the Excel symbol for slope. Okay. Are you guys with me? Just confirm you're with me so we can do the slope thing and then, Okay, great. Thanks, you guys. All right. All right, great. Great, thanks. Thanks, Imadi. As we're just going to do the slope, and what the slope does is to return the slope of the linear regression between the two given points, right? The known y's and then also the known x. So we're going to take this data for separates, right? As the variables that we'll be imputing into the slope function. So here we have 0.30. I mean, before it was in percentage, but beta is typically a number, not percentage. So I did that conversion back to number, right? So you can come here and then change it to any format you'd like. So essentially what this data is telling us is the betas, that's the correlation or the relative strength in the movement or returns being generated by SEPAS and then also by Nigerian market. Then we have 0.3. For beta, we have 1, 0, and then also -1. I just want to have that here. Okay, were we able to get, can we give me the function? Sure. 1 second, please. I'll take the function again. We use the slope, but I'll take that here. I just want to have this written here. Okay. So what we did again was the slope. Again, the slope is meant to help us confirm or generate what the degree of relationship between these two returns are. Initially, we did here, we tried to get the daily return of SEPLAT and also the daily return of the NGX, that's Nigerian exchange. And then I tried to do that interpretation. So I converted this into percentages just to have a clearer picture of what this data means, right? Right. So I was saying here, when the markets, just have a fair picture of what is 1.0 and then 1.04 means. When the markets return 0% from 11th to 12th of January, SEPAS rather, the markets returned 1.29% from 11th to 12th of January 2018, the same period. Here, where SEPAS was returning 0%, we can see the market returning a varying number of returns, or a varying range of returns, basically. And so we took all that return, because beta is typically measured as a number, not as percentages. We took all of this daily return, yes, and then we tried to get what the slope is, so what the correlation is, the relationship between these two variables are, right? And we can come here for the known y's. The known y variable would be the daily return of SEPAT, right? And then the known x variable will be the daily return of Nigerian exchange. So this is So this basically is all of the returns for 1 year for SEPA, and also all of the returns for 1 year for the Nigerian exchange. And we arrived at 0.3% as beta. Are we good now, Tim Ladi?
Yes, we are. Thank you.
Okay, great. Thanks. I mean, this is just like manual way of computing for beta. Also, we can reach out to, the Bloomberg platform already computes beta for each of these stocks or securities, and we can also just pick that information or that data from Bloomberg platform. I'm happy to share that with you guys. If you have networks or connections within your networks that have regular access to the Bloomberg platform, you can also reach out to them, just help you feed them all of this data, right? But in the absence of Bloomberg, and also in the absence of Bloomberg, this can maybe any other site that shares and what the data is, we can always compute that ourselves with the share price history of any stock we're particular about, and also the exchange that we're particular about. Here in this case, Nigerian exchange. You can do that for SEPAT, for Union Bank, for CAP, and for whatnot, right? And I just wanted to have this visual here that talks about the interpretation of beta, basically. So saying if it's equal to 1, then exactly as volatile as the market. So it means it moves in tandem with the market, where the market returns, say like plus or minus 2-3% in returns generation. We would typically see this stuff where if the beta were equal to 1, this beta, or greater than 1, basically, we'll see that return just as much or even more than the markets, essentially. So we have a beta of 0. We say that the beta is uncorrelated. The security or share we're particular about is uncorrelated to the market. So the returns are not in line with the returns of the markets. Where the return is maybe, for example, this return is 0. We'll say the market maybe either do like a 2 or 3%, or where the return here is 4, for example, about 4%, see the market just do 1%, or even less than 1%. For a beta that is negative, if we were to do this slope and wherever that's a negative figure, basically, we'll say the security is negatively correlated to the market. So there's that inverse relationship between that security and also the market and returns. And maybe where the market does a positive return, it's possible for the security to do less than possible, even a negative return. Yeah. And then again, aside from these key 3 areas, there's also the interpretation for where it is greater than 0, but then again, it's less than 1. So it means it is not as volatile as the market. It is less volatile than the market. Where the market either generates like unprecedented returns, it might not reflect the same for the security in question in terms of return generation for that security. So again, just helps us manage or gauge how like the chances of either our forecast materializing or hitting, the chances of the price hitting our forecast or hitting our target price or hitting our recommended price, the chances of the security being as profitable enough when you want to exit or when you want to enter. It just helps them gauge that whole perception of how risky the security is in relation to what your overall investment strategy is. And like I said, for investment strategy, aside from constrained risk, we also want to consider a whole bunch of other factors, time horizon in particular, the work hand in hand, basically. So you just like to have a full picture of what the market's the securities beta is, how it moves in relation to the market. If the market is in say maybe if the market is not performing as well, how would that trickle down or impact your own securities that you're concerned about? And in particular, if market is generating unprecedented returns, how would that feed into your own securities that you're particular about, and basically, and that's about it. So we have the first one, which is basically the worked example, and then we're able to compute that beta ourselves. And with the second with the second sheet, which is beta 2. Again, happy to take questions if we're not clear, if there's anything you need to discuss or touch on more. And if you have maybe suggestions or opinions, different opinions, I'm able to also, I'm happy to address that further. Hi, Khadija, I see your hand is raised. I'll just request to unmute here. Okay, I shared a request on. Hi.
Yes, please. I didn't really get the interpretation for the one that's less than 1 and greater than 1. But this better. When you were explaining the interpretation of less than 1, I didn't really get it. But the better.
Negative? Do you mean -1?
No, like less than 1, like this 0.3. Yes.
Right. The 0. We're saying that it's not as volatile as the market, right? Hold on a sec. So let me just. So for beta is equal to 1, greater than 1, we're saying it's just as volatile as the market or even more volatile than the market for greater than 1. But where we have beta that's in between 0 and 1, so it's greater than 0, but it's not even up to 1. It's not as volatile as the market. We're saying it's less volatile than the market, right? We're just saying it's less volatile than the market here. So we're saying it's not as the volatility is not as strong. Essentially, where the markets will typically do like a 2 or 3%, we may not see the security in particular do as much as 2% or as much as 3%. It won't do up to the market because it's less volatile than the market. That's largely the length and breadth of it. But I'm just saying it helps to assess the degree of sensitivity of this security in question to what the market price or what the market movement is. So where the market is doing like a whole lot, like there's just a consistent rally in the markets day in, day out. You're trying to also assess with the beta, it helps to give an informed view or perception of how the degree of impact, how that would trickle down into your security if you expect that movement to be as much as the market is doing or less than the market is doing, basically. So 0.3 gives you a perception of opinion of a relationship or sensitivity that's not really as strong. So the market does maybe like it's 2 or 3%, either up, positive or negative and return generation. You're not expecting to see that same volatile movement in your own security. Maybe about 50 or 40% of that impact might just trickle down into your own security. But then if we had, say, a beta of 1.5, for example, we're saying it's more volatile than the market, right? So when the market does, again, a 2 or 3%, you might see your own security do as much as the 2 or 3% or even more than 2 or 3% because it's more sensible. The reaction is more pronounced, your own security. So you see more volatility in that sector, in that space, than a 0.3, a 0.4, or even a negative or a 0, to be fair. Yeah, thanks, Adiem. Basically what I'm adding roots 0 less than beta less than 1. Yeah. Okay. So with this, we're able to have yes, thanks. What happens when it's between 0 and -1? And then with the volume of data influence the function of beta. For beta, if it's 0, We say it's uncorrelated to the market. So whatever is happening in the market has little to no impact on the share price and performance of the security in question. It's because they're uncorrelated. So where a market does a 3-4% positive or negative return, you might see your own stock to a 1% or even a negative 1% because the movements are not in tandem. Again, like I said, did make mention of CAP, which was typically my go-to stock. While I had when I had equities and portfolio to manage, as a fund manager, because that would, regardless of what the market was doing, the data just basically showed that CAP really lacked any form of volatility. So it was a go-to to preserve capital, basically, or capital preservation, or to wait out a missed entry period or a missed exit period. And my recommendation would typically go to CAP because it typically average about 19 to 20 naira. I don't think it has moved much, regardless of or despite the unparalleled rally that we saw happened last year. I'm not as sure CAP benefited from that rally as much. So I mean, there will be stocks that have that distinct feature, basically, that may or may not move as much or may not get as much excitement as the market gets when there is an upturn or a downturn in performance, right? So what happens when that's what happens when it's zero. We say it's uncorrelated. When it's -1, we say it's negatively correlated. So they move in opposite direction, just like the relationship between interest rates and then also the yield on debt security, right? They largely move opposite direction. So if one is doing positive, you'd expect the other to either do muted performance or even negative. I mean, that's what negative performance means. And then with the volume of data influence results of function beta, yes, of course. So like I said, 1 year is sufficient for the purpose of this example we're about to carry out, just to have a fair idea of how to compute or calculate beta. But to get a fair view or a thorough view of how this security has behaved over time, again, to help with your investment strategy, you might get as far back as 4 or 5 years, which would, of course, inherently impact what the beta, what the correlation is. Because between those years, you have periods of highs and lows, of rallies, of dips, and then whatnot. So all of that feeds into the final result, which will be the final data of what beta is. It just helps to get a more bird-eye view of that relationship between a security and then the market. So I mean, as much data as possible. 4-5 years is recommended. 1 year is sufficient, but I mean 4-5 years is recommended to get data. I mean, as much as you can. Like I said, 1 year is sufficient. Depending if your strategy is a short-term strategy. If you want to cover or take into consideration all the markets ups and downs, a 3-4 year price history would also work in this case. Yeah. Okay. Yes, thanks. All right. So we have done that beta calculation. That feeds into what the cost of capital would be, what the cost of capital and what the effective or resulting discount rate or discounting factor would be for the purpose of arriving at either a share price or a target price, which again would be fully covered in your valuation session with the facilitator. And that's basically about processing a market risk, which I think really is the new thing. In this whole session, we have touched on liquidity risk. On a market-based view, how to review or evaluate that, which would largely be the bid ask spread for the security, to help again gauge what your investment strategy or recommendations should be, and then what typical premium or discount you would add or recommend to your bid or ask price. Basically, on the company basis, we looked at different financial issues. We had a participant. I apologize, I really don't remember the name right now. But a participant did mention the credit ratio, which really is a good gauge of assessing how liquid a company is on a short-term basis. We also have financial ratios to help assess liquidity ratios for long-term, which is typically called solvency ratio or credit ratios. For the credit ratio, of course, we also had Pelumi, I think, apologies again, give us a point of view or an opinion on what that means in relation to a company as a whole. So the ability for them to be able to meet their liquidity obligations that went due. For credit ratios or solvency ratios, we have the debt ratio, the interest coverage to help assess that interest cover. We also have debt equity ratio, leverage ratio, and whatnot. Basically just helps us to review again the health of this company and also assess what the risk is, if there is an upside or downside risk to this, before deciding this is an appropriate company or a profitable company to recommend for investment. For the operational risk, we touched on, operational just goes across the spectrum, for as little as maybe the lights not coming on as at when due, unnecessary reconciliations, which would mean allocating time to non-value adding tasks, and basically value adding in the broad sense, but on the tactical sense and not value adding, which could have been either allocated to more strategy sessions or investment sessions, basically. And a good way to have an insight into the operational risk for companies would be to look at that cost to income ratio or the operating margins, or how operating expenses are fed over time. For a manufacturing or FMCG company, would typically look at what the turnover, inventory turnover would be, or what the asset turnover would be, to just see whether or not how efficient this company is in turning raw materials into revenue, generating revenue, essentially. You can also do that either on a peer review or industry review, basically. For additional risk, we touched the geopolitical guys, or geopolitical risk, and rather on the global scene, and how that trickles down into markets, and then also into industries, and then also into your company in particular. A good mention was the Russia-Ukraine crisis, which trickled all the way down from the global scene into the daily price of bread, of commodities, of fuel, and then also of interest rates, essentially. So it would be great to have a fair idea of how that space works, and also try to navigate your way into seeing where it trickles down into in your investment space, basically. So that's really about it for investment risk, how to perceive them, how to evaluate them, how to measure them, how to quantify them, and how to incorporate them into your investment and analysis. Again, happy to run through any other aspects that we think needs more discussion, or more like you just want to have a better idea or understanding of what that's about. Happy to run that through. Happy to run through the Excel, any comments, suggestions. It's just basically an open table at this point, guys.
Okay, thank you, Ajoke. Just confirm, are you done with your session? You're waiting for questions, right?
Yes, waiting for questions. I'm basically done.
Okay. So if there are any questions or comments, please, if you want to speak, just raise your hand. If you're unclear about anything at all, please indicate so that we can call on you. Is it that everybody understood everything that was said? Okay, Ade, you have something to say?
All right, thank you.
All right.
I want to appreciate CFA once again for this platform. Thank you so much. I represent Federal University of Technology at Kurefuta. All right. So, but my question may not a bit relate to the risk, but also in need of this information. Which data could you represent, think that could represent the employee satisfaction? Employee satisfaction, getting maybe which you have worked with before, or customer satisfaction. Which of these secondary data can you think has high correlation with the employees of oil and gas or whichever company? Not sure. Thank you. Do you get my question?
You're muted, Ajoke. You're muted. Okay.
Hi, thanks, Adeyemi. For data you can use, or you can use basically to assess this. I would say it's mostly surveys. I think surveys work. There is the Indeed survey. There is like there's that whole survey about is it best place to work, which is done on an annual basis. I'd say that you can use all of those surveys to review and check, because I mean there's really some employees that leave their feedback about how, whether or not they're satisfied working with X or Y company, basically, because on an individual or company by company basis, these reviews, for lack of a better word, are done on a case by case basis. So what would qualify as a set of questions to do that appraisal or assessment in company A might differ for company B, and also because it would also differ across sectors, because different sectors have different operating ways, operating manuals, and then operating platforms, right? So the best to the best thing you can lay your hands on basically to reveal all of that would be to look at surveys from either Indeed or the best place to work annual thing that's done. I know that I'll probably just check that up and then share with you guys. But again, to get that on a company by company basis, I think that most companies will tag that as personal, maybe like IP, intellectual property, or personal property that's not they're willing or unwilling to share with the world. Yeah. And that's you might go to.
Okay, I hope that answers the question.
Yeah, thank you. Thank you so much. Then some of these secondary data, especially for the oil and gas, because skewed towards the energy sector. Where can I get the primary data, the secondary data? So, like the ROI, return on investment, profitability, and the like. Which site will you recommend?
Yeah, for these guys, or for these metrics that you have mentioned, you most likely will get data for companies listed on any exchange, Nigerian exchange, the NYC, the NASDAQ, whatnot. I mean, any company you're particular about, right? As long as they're listed, because those ones then have the regulatory requirements to publish an annual report. But for private companies in any space, oil and gas in particular, it'd be, unless you are able to access that information using your own personal network, it'd be really hard to come by it online or on the internet. Unless you either access that with your personal network, or those guys voluntarily publish their annual accounts and you're able to do that financial review or financial analysis, it'd really be hard to come by. But for publicly listed accounts, of course, they have their annual accounts shared on an annual basis, and you can just pick various line items to compute whatever metric you would want to see.
Thank you.
Yeah, thanks.
Yeah, just to add to that, as someone in the oil and gas space, even though my company is not listed in the Nigerian Stock Exchange, I think that if you go, it depends on what you're using it for, right? If you're doing a survey of maybe companies not listed, you can maybe send an email requesting for their financial statements, but you have to have a valid reason requesting for it. So maybe that would help you in whatever you're trying to achieve.
All right. Okay.
Okay, there's a
Thank you.
question on the group chat. Let me just read that out. Temilade is asking, please, is there anything like management risk, particularly any risk we can associate with corporate governance, and how we can measure it and factor it into our research?
Thanks. Thanks, Imadi. Thanks for reading that. For management risk, yes, of course. I mean, it's a key. I mean, it's a key risk to assess. How do we assess management? We actually assess management risk. I'm looking at the pedigree, the profile of the management team, right? And how largely their pedigree profile helps us to understand what their capacity is in terms of being able to actually drive or achieve growth, or drive a growth strategy, or a turnaround of strategy for a company. And then we just use that opinion or perception of these guys, the money management team, feeds into our outlook or opinion on whether or not these guys are able to drive whatever change or strategy they're talking about in that reports from the chairman, reports from CEO, or what the strategy is for a company for XXX number of years, right? So if you have strong people on the team, yes, that's great. Also in terms of viewing management risk, I mean, a key thing is to also review or assess what the corporate governance structure is like, if there are the required or regulatory committees that should be on board, say the risk committee, the audit committee, the remuneration committee, if there are independent and non-independent directors, if there is that balance of independent and non-independent directors on the board, because at the end of the day, risk feeds from, it's a top-down approach, it feeds from the top management, I'll just say management line to the bottom, yeah. So if there is no intentional efforts or concerted efforts to promote, if there's no intentional effort from the top guys to either be ambitious or to drive change or to promote change or to be intentional about minimizing risk in terms of business and operational risk, then that whole lack of awareness of risk or lack of awareness of drive and intention basically trickles down and feeds down into the lowest level of employment and hierarchy. I just put that to the lowest staff. So again, if we do not have the least red flag essentially would be the lack of maybe an audit committee or an audit board, or no corporate governance. So there is no clear or delineated objectives, rules and objectives of certain people on the board, on the management board. Then that feeds into an opinion of how the business is being run, how management runs the business, and whether or not the management says they're going to, the strategy for next year is to achieve XXX percentage in revenue growth or in PAT. If they do not even have that capacity or previous capacity of driving change in their previous workplace or in their former life, doing all that profile, and then they're not, if you just get all of that opinion, bits and bits of opinions from what they say and then what the numbers actually present, right? And then also what the corporate governance structure looks like. If there isn't a clear-cut governance structure, there isn't an audit committee, there is no need for a third-party review, there's no need for a risk review, a risk regulatory review. They're always caught up in compliance issues or regulatory issues, then it just feeds into what your perception of management should be. And that actually would be a key risk. Another risk would also be to see if it's, typically it would just be like a one-man business. So one person calls the shots, one person is the CEO, one person is also the chairman, is also the remunerations head, is also the internal control person. That's just one person having too much control of risk, right? So that feeds into your perception of how well the business will run, how realistic companies' projections or strategies would be. And if they say they're trying to curb operational expense by X%, your perception or opinion of that whole structure in terms of the management team would fit into how well you think they would actually achieve their goals. So that's really important. It just helps to fit into what your outlook is on that company. Can they really do this? Can they really do X? Can they really do Y? And whatnot.
Okay, thank you. I hope that answers the question. All right, thank you, Timilade. Any other question? Any other comments? Okay, if there are no other questions, I don't know if anybody from the organizing team has something to say. This is potentially our last session. So if anybody from the organizing team has something to say, please let's have that now. Okay, thank you all so much. So far, I think we've had great sessions. Thank you to the facilitators so far. Thank you, Ajoke, for your time, for your knowledge that you've shared with us today. Thank you so much. To everybody who have been on this session, to everyone who has been consistent, to everyone who has attended maybe 1-2 sessions or even all the sessions, I hope that it will be helpful. I hope it has been helpful. I hope you've gained 1 or 2 things. I hope that you can be able to put it into good use to practicalize and shine with it, essentially. Dr. AK, I thought that your mic was unmuted. Do you have something to say? Hello, Dr. AK. Okay, I guess that was a mistake. Okay, can hear you.
What are you for me?
Sorry?
I just want to appreciate
Okay.
all the lectures so far. For the past almost a month now, I'll be having lectures. All the classes I have to appreciate for the rich lectures and particularly the facilitators. I want to thank them seriously for enriching the students, the candidates, or the research candidates. So thank them. Thank the CFA. I'm very grateful for Awesome for driving the investment industry to greater heights. Thank you.
Okay, thank you to you too, Dr. AK. Abraham, I'm just going to put you on the spot. If you have something to say. I don't know if you're there right now. Okay, I don't think it's there right now. But thank you to everyone again. Thank you to the host. Thank you to CFA. Thank you to myself. Thank you to the students for coming out. Thank you to everybody. If anything changes, we're supposed to have, from the yesterday's session, I'm not sure we completed financial analysis, but if anything changes, we'll let you know. We'll drop the materials as we've promised on the group chat. Please, again, just to say again, the group chat is not just to pass information. If you run into a jam at any point, if there's something you're unclear of, please use it use it judiciously. Ask questions. Do not be scared of asking questions. Ask questions. If you're worried if you're shy, I don't think you should be shy of using the group chat. You can message any one of us directly. Hello, Adeyemi, do you have something to say?
Okay, I said, please do not forget to also drop it with the advisors too.
Sorry?
On our platform. I said, do not forget to drop the link on the CFA advisors platform too.
Okay, we'll do that. We'll do that. So thank you all so much. Like I said, this is potentially our last class, and I guess I'll see you at the top. Take care and have a good afternoon.
Thank you.
Thank you.